Hey guys, and welcome back to my YouTube channel. I'm really excited for this video because the inspiration for this video came from real life, where a lot of my other videos, it's more like an academic thing, or like I find another YouTube channel, I'm like, oh, that's cool. But the inspiration for this video came from a conversation I was having with a friend, and she has a sizable amount of money to invest, and I was kind of explaining to her why she should probably invest in stocks, and she was like, is investing even real? And that question really caught my attention because I was like, yes, it's real. Like, I'll show you a graph or something. And then I was like, okay, I'm just gonna make a video that can show people that investing over time definitely grows your money. And that anybody who's not investing early is really, really missing out on something that could be super useful to them long term. So the two biggest and most popular wealth creation tools in history have been stock investments and real estate. But if you're a beginner investor and you don't have a lot of money to invest, then investing in stocks is a way more affordable option than investing in real estate. So first of all, what is a stock? A stock is a little piece of a company. So you're probably wondering, why would a big company like Apple or Google let random people buy a piece of their company? Well, having a bunch of people buy into their company gives them more dispensable funds to work with. And then, as a reward or compensation for investing into their company, you'll be paid proportionately to their growth or to their losses. So if Apple keeps growing over the next couple of years and you invested in Apple, you'll make some money, and if Apple falls apart or goes bankrupt or something, then you'll lose money. So if you buy stock in a big company, let's say Apple, and the value of that company grows over time, then you will make money off of the investment that you made into that company. If the value of that company decreases over time, then you will lose money proportionately to the decrease in that company's value. So who owns stocks? What percentage of Americans own stocks, etc.? So 52% of American families own some amount of stock. And of the top 10% of wealth in America, 92% of those families own stocks. So if you want to mimic the people who have a lot of money, you should definitely be a stockholder, because 92% of the top 10% of American families own stock. So 48% of American families are missing out on a huge opportunity to grow their wealth. You know, everybody has $100 to invest. And if you start investing small amounts at a young age, that can really, really compile over time. So it's a huge missed opportunity that I think really just amounts to a lack of education. Most people just maybe don't know to invest. So let's get back to my friend's original question. She said, is investing even real? Prove it. Okay, so the cool thing about investing is this thing called compound interest, right? So if your investments gain 10% on their total invested amount over time, so each year you get 10% on what you've invested, then if the first year you invest $100 and then you have 110 by the end of the year, the second year you're not getting 10% on your first $100, you're getting 10% on your $110. So over time, this really, really adds up and can create a lot more value from the initial value that you invested. Let's be conservative. Instead of getting a 10% return on your investment per year, you're going to get an 8% return on your investment. If an 18-year-old invests $28,000 by the time that they are 26, and they have no additional contribution to that fund, but they just leave it in a fund that's getting an 8% investment return each year, then when they retire, they will have $1.8 million. So imagine taking $28,000 and just leaving it somewhere and then ending up with $1.8 million over the course of 40 or 50 years. So that's why investing is so important, because you want to get that 10% or that 8% return on your money each year, and it really adds up over time. Additionally, statistically, stocks have a higher rate of return on investment than real estate investments. Over the past 60 years, the average index fund or mutual fund has gotten an 8 to 10% return on investment annually, and the average purchase in the real estate market has gotten a 4 to 6% return. But Ingrid, you said I could lose money. What makes you so sure that these companies are going to keep growing? What if they decline and lose money? Okay, you're kind of right. Investing in any one company could be really risky. That company could go bankrupt. Something bad could happen to that market. Like if we look at COVID has affected different companies very differently, right? So investing into any one company can be risky. But if you invest into a diverse portfolio and you have a lot of different companies that you're investing into, the risk is actually not that high. Basically, what is the chance that the American economy does not grow at all in the next 20 years? Basically zero. Basically that's not going to happen. Basically, if you invest your money into 500 different companies, the chance that those 500 companies as a pack is not going to grow is really, really low. So what about economic crises and downturns? Yes, the market always will have depressions, it'll always have recessions and downturns. But if we look at a historical graph of these downturns and we look at over time, what usually happens is maybe for a year, maybe for 6 months, even 2 years, the market might be depressed, but it always goes back up, and it always goes back up to its original value and then continues to grow past that original value. So if you're looking to take your money out when you're older and you're a younger person right now, don't even worry about the downturns. Don't look at your stocks during times when they're going down. Just believe that it's going to go back up because history shows that it always goes back up. So never take your money out of the market in a downturn. Never get freaked out that, $40,000 is suddenly 30 or something. You're like, oh my God, this is terrible. No, you can only lose if you sell at that point because the market's going to go back up. So wait it out, and for sure that money will go back up to its original value and then probably continue to exceed that value. So just to prove to you guys that markets always go back up, I'm going to include a few graphs right now from the S&P 500 and the Dow Jones Index. So these are total aggregate representations of the American economy. So they represent a lot of different companies at the same time. So basically this is showing the growth of the general American economy. And as you can see by these graphs, the market just keeps growing. Even through downturns, the general trajectory is always up. So I hope these graphs really illustrate that, and I hope that it makes sense to you visually, because when I saw these graphs visually, it really made sense to me. And it was a big game changer when I was able to see the picture. So I hope this helps. Okay, so now you're convinced and you want to invest. So how do you invest in one of these funds that has a bunch of different companies? Because obviously buying 500 stocks individually is going to be really challenging. So you want to pick an index fund, whether it's the S&P 500 or the Dow Jones Index or something. You want to pick a fund that already represents all these companies. So when you buy into the fund, let's say you buy one share of the fund, it's a $300 share. In that share is 500 different companies. Even though you're only buying one share for the fund, it's representing those 500 different companies or how many it is, and it's going to diversify your investment. I have a video on index funds and mutual funds and ETFs and what the differences are and stuff, so I'm going to link that in the description. If you don't know what an index fund is, check that out for sure. So what if you want to use the money that you invested? Well, you have access to it. A lot of people have rainy day funds or savings account. Yes, you absolutely have access to your investments. If it's in a downturn and you sell, then you're going to lose some money, but you can liquidate your stocks really, really quickly. And that's another asset, stocks versus real estate investments. You can't really liquidate a property super quickly. If you need those $100,000 that are tied up in a property, you can't just be oh, let me just take 10,000 out of it, No. So with stocks, you can do that. You can absolutely sell any percentage of your stocks at any time and immediately have that money back into your checkings account. So an inspiring statistic to me was okay, a lot of y'all probably want financial freedom. Just the idea that you could live off of money that you make passively. So how much money would you actually have to have invested in order to survive off of your investment income's interest? So if you had $500,000 invested, it would probably yield at a 7% return rate about $35,000 a year. if you had $1 million in an investment account yielding a 7% return annually, that's $70,000 a year that you could live off of. So if that's something to aspire to, having $1 million portfolio, that way you can just chill or do whatever you want, that's the number that you need in order to get back a certain percent of livable interest money. So another crazy statistic or interesting fact is that there are actually a lot of tax benefits to having a lot of investments. So the top percentiles of wage earners get taxed at about a 30 to 40% tax on their income. And investments, no matter how much you have, like dividend income, actually gets taxed at a 20% rate. So if you were living off of your investments, your tax rate would actually be lower than if you were one of the highest earning workers in society. So that's just like a cool fact. So another powerful reason to have investments is that investing helps you beat inflation. So a lot of people think that having money in a savings account or in a checking account is safe. Actually, it's not safe. Have you ever heard your grandmother say, like, I remember when I was back in like 1960, you could get bread at the dollar store for like 30 cents? Okay, well, like bread you can't get for 30 cents anymore, right? So if you have your money in a checking account or in a savings account, you might actually be losing money annually. Like you might be losing like $4 every year on $100 because of inflation, because prices go up over time. As the government prints more money, each dollar is worth a little bit less. So investing can actually help you beat inflation to ensure that your money is keeping up with the prices year after year. Another way to make money from the stock market, other than capital gains, which is the money that you make when a company grows, is dividend payments. So dividend payments are paid to you when a company has a lot of profits. So some companies share their profits with their stakeholders. So I know Apple pays dividends, Walt Disney pays dividends, General Electric pays dividends. So for every like $100,000 that you have invested, you might get like $400 a month, I think, something roughly around that, in dividend payments. So yeah, dividends are another way that you can have a more regular income, other than just your capital gains, which are fluctuating with the market. Okay, so you want to invest. How do you physically go about doing that? So you could take a more old school route and you could hire a financial advisor, or you could get in a consultation with an older, more established firm like Charles Schwab, Fidelity, or Vanguard. Or you could go the more new school route and you could download a low-cost brokerage app. Some examples include like Wealthsimple, Robinhood, Wealthfront, Webull. I was actually thinking about doing a video reviewing some of these apps, but they basically let you invest with very low fees because there's no human advisor advising you, or even Robinhood has no fees on your trading. So if you want to diversify your portfolio in one of these apps that doesn't have a human advisor diversifying your portfolio for you, just buy into an index fund. Buy into an index fund that has a bunch of companies represented, and you can actually do that on Robinhood. So I am going to tell you now what to look up in Robinhood to invest in an index fund. Okay, so on Robinhood, the name of the S&P 500 index funds are SPDR, SPDR, S&P 500 ETF, and iShares, S&P 500 Core ETF, and Vanguard, S&P 500 ETF. So those all do the exact same thing. They all represent the S&P 500 index, and they're just different companies that are allowing you to invest in an index fund. So just look that up on Robinhood, and then you can invest in an index fund. Some of these apps that I mentioned before, they actually recommend portfolios for you. That could also be really safe if you choose like a moderate or an average risk profile or whatever. I'm sure they're just investing most of your money into index funds anyway. You can also do that if you feel comfortable with a certain app that does that. So yeah, some of the apps, when you log in, they'll ask you a bunch of questions about your income, your investing risk profile, your age, whatever. And then they'll give you a recommended portfolio. So just keep that in mind, and those are the different ways that you actually go about investing if you don't want to hire a financial advisor. But if you do, go ahead and do that. There's a bunch of different ways to accomplish this. The easiest one is through probably Robinhood and probably buying it into an index fund. So, yep, that's what I have for today. I just wanted to debunk the myth that investing may or may not be real. Yeah, if you're not subscribed yet, subscribe. I will continue to churn out content about finance, which will hopefully help you and make your life more plentiful and fruitful in the future. And I hope those graphs were helpful to you. Those really had a big impact on me, so just wanted to spread the word and keep you guys informed. So, see ya. Have a good one.